How's it going, everybody? I'm the BTC Reaper, and I've been trading for 5 years, and I've had a few great mentors. They have taken me from being a trading noob to a profitable trader. My goal on this channel is to teach you how to make money whether price is going up or down, no matter what market you're trading in. Do you ever find yourself wondering how strong the current trend is? RSI, or the Relative Strength Indicator, is a great tool to use to determine the strength of the current trend when trading, and we'll show you how to use that in today's video. In order to add RSI, all you have to do is click this indicators on top, and it'll open up this screen. You might not have favorites if you haven't used any indicators before, so you might not get anything right here like I have. But all you have to do is type RSI, and you'll see Relative Strength Index. Click that, and it adds it to your chart. Double click it. I changed my RSI to green, and my moving average for my RSI to red. The moving average takes how the RSI is moving over time and creates an average line of how RSI is moving, whereas the RSI line is just how the RSI is actually moving. And when you get crosses in those, you typically have bullish or bearish movement. And what a cross is if you look down here, if I can get rid of those bubbles, so you'll see where this red crossed above this green. If you look at the top chart, you can see price action dropped, where when red went under green, kind of hard example in a bear market because it doesn't, bullish stuff doesn't always work in a bear market. But right here you have red under green, and we got a slight pump up before we wound up crossing back the other way and falling down. So I use the green as good, red as the bad. You don't want your baseline to cross under the moving average line if you want an uptrend. So we double click this RSI. We're just going to look at the indicator itself right now. You'll see there's the 70 zone, and it goes up to like 100. I think it'll show other numbers. Yeah, it shows other numbers, but it stops at 100 typically. And then the bottom will stop at 0 typically. So the 70 to 100 is the oversold area. That means that too many people have bought in a given time period, or that price has just continued to go up for days on end. So when you are in the oversold area, generally you want to take profits, because that means that price may take a corrective action downwards. So it's a good idea to take profits. You can do it however you want, but that's usually how people will use the indicators. When you're starting to get high and you can see it starting to want to come down, you take a bit of profit. Where this 50 line, this is more of our neutral line. So we don't have bullish movement and we don't have bearish movement at this 50 line. It's just an in-between zone. So 50 to 70 though, that is another bullish area, as well as the 70 to 100. When you cross over the 50, it typically means that you could see some price action upwards, and that you could have a bit of a rally or a continued rally. Kind of depends on how everything else is looking at the time. Just remember, you never want to take only one indicator. You want to use multiple indicators, all in confluence, to come up with your idea. So 50 and down to 30, this is your bearish zone, or your downward zone pressure. So when you cross into this 30 zone, like right here, typically price is going to come down and it's kind of hard to come back up. We're on the daily, so this was quite a few days. December to to the end of January, so close to 2 months here. Under 30 to 0, that's typically a good value zone because price is typically oversold at that point, meaning that too many people sold off too quickly, or we had too many days of downward action at once. So if we go back to having our chart, stretch this out so we can see it a little better. So you follow the dotted line up, you can see that we topped out right here, and then we started coming down. So as I said, that's typically a selling zone. You might say, hey, we went up though. That is what we call a bearish divergence here. So if we go and measure there, and we measure here, you get what some people will call an alligator mouth, and usually this means that as you're diverging away from each other, you're going to end up following with the price action. So if price is going up and your oscillator is coming down, typically price will eventually come crashing down. And you can see that after a couple days, it did that, and it's been going down ever since. A bullish divergence could be where price is going down, like this, and your RSI is going up like this. So it's creating like a triangle that'll touch, and that creates some pressure that'll end up releasing to the upside typically. If you want to learn a little bit more about bullish and bearish divergences, feel free to join my Discord, and we have some resources in there, and you can ask me questions or ask any of my other traders some questions, and we'll gladly help you out. If you liked the information in today's video, or you have some differentiating information, please leave a comment down below, like our video, and subscribe to our channel. Thank you and have a wonderful day.